All right, greetings. It's a little bit late on a Wednesday night, and I'm just trying to make up for some issues we had with the 7 o'clock recording because there was a lot of feedback I was getting. It was here. It was like I could have been at the Nationals baseball game today, announcing from the public address system. That's what it seemed like. Every word I said, it was coming back to me 2 or 3 times, and sometimes even 10 seconds later. And the same thing with your questions, and so it really hampered my abilities today. So I'll point out a few things. One, just go through the available for sale security, the reminder that available for sale security and trading securities, when we make these decisions, it's made by management. They determine what type of security it is. At any rate, the investment account is always pegged to the fair market value by way of increasing or decreasing the investment account from where the investment account was last to the new fair market value when we issue a statement. And the difference was only that trading securities, the unrealized gain or loss went to net income, and the available for sale security went to other comprehensive income. But the key is to know that, this is the distinction, but the main understanding is to realize that the investment account will always either go up or go down to reflect the fair market value at the time you do this. And this happens as unrealized gains or losses until the actual sale occurs. Then it gets realized and we're done. It's out of there. That's number one. Number two, to point out that when it comes to the equity method, not to forget, and to make sure you understood, that the earnings that we record on the equity method are the earnings that come from the investee company that we own. And it's at the percentage of ownership. Percentage of our ownership. Same thing with dividends. When we receive the dividends, if the earnings increase the investment account, which they do, the earnings increase the investment account, make sure you see that for the reason that that's what the equity method is doing. It's charging the earnings to the investment account as a increase, or in case of a loss as a decrease. And the same thing with dividends. It's like a return on the earnings. So if the earnings went to the investment account, the dividends are going to come out of the investment account, like a return on earnings. And dividends, it's the same concept. It's based on percentage ownership. All right, number 2. Or number 3, I forget which. But when you are doing the fair value method, which is what you do for less than 20% ownership, and then you're deciding whether it's available for sale or trading securities, you're asking management what they intended. When you're doing all that and you're doing the unrealized loss or unrealized gain, keep in mind that with the equity method, which is where you have 20 to 50% ownership, keep in mind that under the equity method, dividends, as we just said, is a return on investment, so it goes against the investment account. But under the fair value, dividends are income too. So we didn't quite make that clear tonight. Dividends are income. And they go to the income statement, unlike the unrealized losses, which could go to, or unrealized gains, which could go to other comprehensive income. In the case of available for sale securities, dividends income is income to the net income. All right. We spoke about stock dividends. Just want to make sure you realize that the important language on that agenda, which is probably in the textbook as well, is it's a capitalization of retained earnings. That's the description that they use, capitalization of retained earnings. So it basically means the following. You've got a certain number in retained earnings. That's going to be a credit balance. So to do it on a T account, it's going to be over here. You're going to move it this way, because what you're doing when you move it this way is you're actually offsetting the balancing entry to stock. It's either common stock or paid in capital, depending on par value. So this offsetting X goes to the stock, basically taking retained earnings and moving it out of retained earnings and putting it into paid in capital or par. It's increasing the stock amount, so it's putting it into the capital, if you want to call the stock the capital of the company. So it's moving some retained earning. Even though there's no cash and it's just a stock dividend, it's actually moving some of the retained. That's the entry that we make. Okay, let's see. And while we just said that about stock dividends, it's the realization of why this is true is think of stock dividends as not much different than cash dividends. Where do cash dividends come from? Cash dividends is coming from retained earnings as well. Don't forget, we showed you that retained earnings is increased by income during the year, and it's also reduced by dividends paid. So in order to remember this with the stock dividends, it's the same doggone thing. Stock dividend declared, and it comes out of retained earnings. And don't forget that we have the rule for the 20 to 25% stock dividend that we basically do this capitalization on the fair market value of the stock. If it's greater than that, it's just par. Okay. And one last thing about the dividends. Remember, there's the 3 dates. The date of declaration, that's really when it becomes a legal obligation. So the main entry occurs then. Sort of like that. This entry occurs at that point. And instead of cash, it'll be called dividends payable, because we haven't moved the cash out when we pay a dividend. Number 2, the recordation date, that's really nothing happening there. It's just a recording who's going to get the dividend. So that's the recording date, and then the date the dividend is paid is just a reduction of the liability. So the real date for when everything happens is the date of declaration. And we mentioned that some companies buy back their treasury stock and then they reissue it. Sometimes they reissue it, they resell it to the public when the stock has gone up in value. It could be that they need money and they have to reissue it when the stock has gone down in value from when they bought it in these cases. So it can create sort of like a gain or a loss. But that gain or loss, that's why I said the word sort of, that gain or a loss is not recorded as a gain or a loss. It's a plug. That's a good analytical thinking question. It's a plug to something else in the equity section where we talk about plugs a lot. We talked about plugs to the not retained earnings. That was a fool you, but to the paid in capital or additional paid in capital. So that's where we plug that treasury stock gain or loss, because it's got to go somewhere. And it's not going to be shown as a gain to the net income statement, that's for sure, because that would be misleading. Companies would then, in order to boost up their net income, they would be buying their stock and trying to sell it at gains all the time in order to boost up their net income. So we plug the gain or loss to the additional paid in capital. And I guess my last point would be just to make sure you remember that there is something called the fair value option. The fair value option method can be elected for even items where we are supposed to be doing the equity method. We can override the equity method by electing the fair value method. And if that's the case, if we do that, then in theory you would go with the AFS concept, because under the equity method, those stocks are not usually being bought at for quick trade. You wouldn't buy 40% of a company for that fix. But the point is that you can elect the fair value option. That's what it's called. And as I said, or I would hope to have said, that a lot of companies are doing that. Okay, that's it.